Hi, and welcome this afternoon. Thank you all for taking time out to join us. My name is Bill Harrington with Advantage Futures. We're excited about this next edition of our seminar series. It's been very successful, and as we can tell from the turnout today, you guys seem to be enjoying them. Today we welcome Fred Sturm from the CME Group. Fred is a Director of Financial Research and Product Development. From 1999 to 2007, he served as Senior Economist of the CBOT, where he collaborated in the design and launch of various new contracts, including agency futures, mortgage futures, interest rate swap futures, the Dow Jones AIG Commodity Index, and binary options on the targeted Fed funds rate. Prior to the CBOT, Fred was first Vice President of Futures and Options with Fuji Futures, where I was able to work with Fred. That is now Mizuho Securities. And before that, he was an analyst with Car Futures, now Callion. Fred earned his Bachelor of Arts degree in Economics from Indiana University and his Master of Arts and Master of Philosophy degrees in Economics from Columbia University. So if you can all join me in welcoming Fred. He's going to give us about a 45-minute speech, and we'll have some question and answers after that, and hope you guys enjoy it. Thank you.
Billy, thank you. Thank you very much. That bunch of contracts he recited that I've had a hand in designing, those of you with good memories will know that most of those aren't around anymore. Failure is a big part of my life. I'm really grateful to Joe, Tommy, Billy, Iqbal. I have a lot of other old friends in the crowd here, so it feels like home to me. It's good to be back. Let's let the taping begin. So, good afternoon. I'm Fred Sturm. I'm a director in the Research and Product Development Department of Chicago Mercantile Exchange. And I'm here today to give an overview of Treasury futures and Treasury cash to futures relationships. Let's emphasize, this will only be an overview. Details matter, but if you get bogged down in details, I could keep you here for 4 hours. That's tiring, it's fatiguing. This should suffice just to let you know what's important, where to direct your attention, what to be thinking about if you trade either Treasury futures or cash to futures spreads. So what I plan to do in the next 40 or 45 minutes is just sketch the contract design itself. This may seem tedious, but I'm horrified and amazed at how many people think they know something that isn't so, or don't know something that they ought to know about. I will then jump into the cash to futures basis. The basis is important partly because it's a trade. In many seasons, it's a very interesting and profitable trade, but it's also the foundation on which you think about fair valuation of Treasury futures. We'll take a look at a couple of the embedded options. These are pseudo options. They're not really options, but there is optionality embedded in the Treasury futures delivery mechanism, and we're going to look at a couple of aspects of that. And then just close with a couple of observations about common sense. We ought to have some time left over for questions. Iqbal is going to be standing in the right wing with a cane if I run over. So, here in a nutshell is the Treasury futures suite as you see it today. All of these contracts work essentially in the same way, and yet they are all different. If you scrutinize them, you'll see they are different in detail. Some of these are $100,000 notional contracts, 5s, 10s, bonds. You know, those that are at the short end of the yield curve, 2s and 3s, are 200,000 notional. Some of these trade in tick sizes of 1/4 of a 32nd, others in halves of 30 seconds. Newsflash, something important. As of the 30th of August, the range of variety gets even bigger because bonds will go back to a full 32. So you will have some of these trading in quarters, some in halves, well, the 10-year in halves, and then the bond in a full tick. Deliverable grade, trivially, this is different for all of these. What's deliverable into a bond contract? Any bond with a remaining term to maturity of 15 years or more. I mean, right now that's 15 to 30 years. If the U.S. Treasury Department were to start doing as some European governments have done and issue a 40 or 50-year bond, that would be deliverable grade. What do 10-year notes take? Well, essentially, current and old 10-year notes down to 6.5 years to maturity. 5s take things that are issued as 5-year notes. We allow 5 years and 3 months term to maturity, but it can't have any more term to maturity than 4 months, or 4 years and 2 months. The same sort of bracketing applies for 3s. The range is 2 years, 9 months with a cap of 3 years, 1 year and 9 months with a cap of 2 years for 2s. In both of those cases, old 5 years can drift down into the deliverable grade from above. Why am I belaboring this point? We tend to think of Treasury futures as trading against like a Treasury issue, perhaps the on the run, perhaps what's cheapest to deliver. Always, always, always keep in mind that lots of things are potentially deliverable. This is what makes these contracts interesting to trade. This is what makes the cash to futures spreads interesting. Interesting variety of contract critical dates. We're going to take a closer look at these, the 3 columns out to the right there. For some of these contracts, the last trading day is the last business day of the expiry month. For the oldest of these, the bonds in the 10 years, stops trading on the 7th business day before the last business day of the month. Why would that be? The short answer is that this is how a grain futures trader would think about a Treasury futures contract. You might imagine that it takes that long to get your hands on a Treasury security to deliver it. What about last delivery day? Bonds, 10-year notes, you can deliver those on the, as late as the last business day of the expiry month. For the others, 2s, 3s, 5s, you actually have until the 3rd business day of the month after the named expiry month to make delivery if you want. So a SEP future will admit physical delivery as late as the 3rd business day of October. Let's look a little bit closer. It helps to visualize, what is deliverable. Let's go back to that middle column in the previous table. What do these deliverable grades look like? Those are the notes back there, and these are the bonds. So here, let's take SEP 09 note futures as our case. For the 10-year, you're going to have 20 issues that are deliverable. 5 of these are going to be 7-year notes. 1 new, 4 of them old. The other 15 will be things that were issued as 10-year notes. Sizes, I'm happy to say, are getting bigger. I like to see big sizes of deliverable grade. For 5-year notes, everything that's deliverable was originally issued as a 5-year. For both the 2s and the 3s, you have these interesting deliverable baskets that are split between things that are issued as new 2 or 3-year notes and things that were originally 5-year notes that have just grown old. They've drifted in from below. So this is why you get this sort of funny alternation in the quantities that are available. For an old 5-year note in either of these cases, it's going to be about 13 or 14 billion that might show up as the issue that's most attractive to deliver. If it's something that was issued more recently, it's going to be a lot larger. It'll be 35 or 40 billion. You can see this cluster of 7-year notes right here. This is all that 7-year Treasury underwriting activity. Further out in the 10-year basket, you've got issues that are as large as 60. They get auctioned, then they get reopened and reopened again. So you got these mega issues that come up. Roughly the same thing applies to the bonds. The bond deliverable basket fascinates me. Here's this big no man's land, this big gap, between about 22 and 27 years to maturity. If you're of a certain age, you can remember when there were not 30-year bonds being issued by the U.S. Treasury. The U.S. Treasury kind of got out of the business for a while. That's what that gap looks like. In the financial environment we're in right now, the things that are going to be most attractive for making delivery on contract happen to be pretty small. These are really, really old bonds, and they are all, in the neighborhood of, what, 9, 10, 15 billion. The stuff that's coming out more recently is much larger. I get a lot of calls from people saying, well, what exactly is deliverable? And so we have a funny way of measuring time. And what you see in this slide is a cookbook that tells you how we measure time. Essentially everything, every maturity date for a candidate note or bond has to be reduced to the first day of the month and then compared to the first day of the futures delivery month. Once you've got that straight, then you understand. But we get into sort of heated arguments with people who don't read the rule book correctly or who don't understand this. And so it's useful to have this. In the interest of saving time, I'm going to leave you to read this and just go through the example. And I want to be assured that everybody's got this at his fingertips or can get it. Do we or don't we? If not, I can email it to you, and I'll be glad to. But anybody who wants to keep tabs on what might be deliverable grade in a deferred contract, or if the Treasury introduces some new 4-year note, or they start reintroducing some term to maturity that we've never seen before, where will it fit into deliverable baskets? When will it become deliverable? This is how you think about it. This is something else. It may seem obvious to most of you, but I am astonished at how many calls I get from people who just don't understand contract critical dates. The delivery process, it's a 3-day process. Most of you probably will not be trading for physical delivery. You can, if you want to, but a lot of institutional portfolio managers, for example, do not. The people who enjoy doing this tend to be relative value traders and arbitrageurs. There may be some of you in this crowd. Delivery is a 3-day process. And the first step is announcing your intention to deliver. That's 2 business days before you're actually going to deliver. So on the 2nd business day before the 1st business day of the contract expiry month, your clearing member firm has to say to the CME clearinghouse, we're going to deliver. The next day, notification day, you have to tell the clearinghouse, I'm assuming you are short, you have to tell the clearinghouse what you are going to deliver, which note, which bond, which issue. What are you going to use to fulfill contract? The next business day is when all the rubber meets the road. This is when securities get delivered and invoice prices, those monies move in the other direction. First intention day, first notice day, first delivery day, that's easy. It's all the same. It's just as I said. First delivery day for any Treasury future is the first day of its named month of expiry. Note that these things do keep trading. Oddly enough, I get questions about this. These things do continue trading while they are eligible for delivery. Longer dated stuff stops trading on the 7th business day before the last business day of its expiry month. So for bonds, 10-year notes, in September, it's going to be the 21st of September. The other stuff, the shorter dated note futures, you can trade those down to the end of their named expiry months. You have a similar staggering of delivery at the end. For a bond or a 10-year, your last delivery day is the last business day of the month. So for September, it's going to be September the 30th. If you think you're going to make delivery on a short position that you hold, you're going to have to let people know by the 28th, close of business. For 5s, 3s, 2s, as I said, the delivery cycle extends a few business days into the next month, so you've got more time. Maybe it's the variety that, or just the differences that throw people off, but you know, it helps to know this. If you're going to play cash to futures arbitrage, especially during a delivery month, it pays to know just cold when things stop happening or when your opportunities run out, what your time constraints are. You don't want to have to call me and have me remind you that yeah, it's too late for you. It pays to understand what happens at delivery. Physical delivery is what makes Treasury futures honest. People like Treasury futures because, you know, something actually happens at expiry. There's no, you know, sometimes people are suspicious of cash-settled futures because they don't understand the indexing mechanism that makes cash settlement, or they're suspicious of it. Physical delivery is pretty ruthless. There is this transaction, end of story. And the people I know who like these contracts and who enjoy trading them and who have a lot of faith in them like precisely that ruthlessness. Things get really, really honest. So here, it helps to pay, or it pays to understand what exactly happens. The futures price, that P up there, expressed in points, 30 seconds of points. Yeah, you just take that. That would be like the daily settlement price on the day you make your intention. You multiply that by $1,000 in the case of a 10-year note. It'll be $2,000 in the case of a 2-year or a 3-year note future. Multiply that by the conversion factor for invoice delivery. Round it appropriately, and then add the accrued interest. At this point, it's like a Treasury transaction. I get into a lot of heated discussions with people who don't understand when rounding takes place. It seems trivial, but on large positions, you know, rounding may amount to, you know, a few dollars, and dollars matter. So the thing that's in the parentheses up there, the converted futures price, gets rounded. If you have a trailing ½ cent, it gets rounded up. But these things get rounded per contract to the nearest cent. It's not per position, it is per contract. The same thing happens for accrued interest. Accrued interest is per 100,000 face value. That's the thing that gets rounded up to the nearest cent. I have people saying, well, gee, I have a position of like 10,000. Why isn't this 10,000 lot position being rounded up to the nearest cent? And it's easy. Those aren't the rules. Rounding is at the contract level. It's a detail. It might be an important detail for you someday. It's important to know. Just to save time, this is an example that works out in gory detail how delivery invoicing is supposed to work. You can see another such invoicing example in our rulebook chapters. The rulebook chapters, by the way, that lay out these contracts, terms, and conditions are pretty clearly written. They're actually, they don't read like, you know, fake legalese. I like the way they're written. So you can see examples of how this is supposed to work. And a little bit of time invested in studying those is something that will pay you dividends. Those are the basics. I mean, there are a few things you have to know or need to know before you're going to start trading these things. That would be it. You can always know more, and knowing more is always better. But let's move on to the cash to futures basis. Well, what is it? The definition is right up there at top. It's nothing for, first of all, pick out a deliverable grade issue. And for this purpose, let's use the June 09 10-year note futures as our empirical whipping boy. So for any one of these deliverable grade issues, you can pick one, and on some day before the expiry month, good, find out what its spot price is. You can see that. You look at an interdealer broker screen, or you look at Bloomberg. Subtract from that the June 09 futures price multiplied by the pertinent conversion factor, and you've got the basis. And most people like to look at the basis in terms of 30 seconds. So out on the far right-hand column, there it is. No mystery. If you get into conversations with people who trade this stuff, you may find them talking about the basis in terms of specific issues that are deliverable grade. That's natural. Most people want to talk about the basis versus whatever issue happens to be cheapest to deliver, or most efficient to deliver for the short on any given day. You may find a few people talking about the basis relationship versus whatever deliverable grade note is on the run. On this particular day, that would have been the 3 1/8 of May 2019. But it's important to remember that you can compute a basis for anything that's deliverable grade. A good thing to do, because if there's a lot of volatility, or if we're in an environment where a lot of things might emerge as plausible candidates for cheap to deliver status, you want to be watching those. You can concentrate on whatever happens to be cheapest to deliver right now, but the trade for you is what happens next. Terminology is important. If you're long the basis, what does that mean? Well, you're long cash and you are short futures. So basis is, conversations about basis are founded on this premise that we're looking at it from the viewpoint of the futures short. You're looking at this from the viewpoint of the person who is going to acquire a Treasury security today and then deliver it into the Treasury futures contract later on. And what happens to his spread? Does he profit from it? And so on. So when you say long the basis, that's how you think about it. Note that this is not one-to-one. I mean, it's a piece of algebra, but if you're going to put up a trade, you have a cash position, you are short futures, you're almost certainly not one-to-one. There is a hedge ratio. It is what? It's the conversion factor. You can see it in the algebra right up there. If you actually implement a basis trade, your futures position, the number of futures contracts that you're using, is essentially that conversion factor. Now, the basis can be interpreted as this thing that converges to something close to zero at delivery, and this amount will be what? It'll be the carry that the owner of the Treasury security is earning on that security. What's he earning? He's earning accrued coupon. That's wonderful. What's he paying out? He's paying out repo financing, or federal funds rate financing, or LIBOR, or whatever he's using to finance his position. That's a cost to him. But that that difference is carry. What's left over is the value of these embedded delivery options. So, think about the logic I gave you a moment ago. If you're long the basis, you're short the futures. That means you are long options. Conversely, if you're short the basis, what does that mean? Well, you're long the futures. You're also short these delivery options. What exactly are they? Well, there is this quality option. We'll look more closely at this in a moment. If you're short the futures, it's up to you what you're going to deliver to fulfill contract. You can deliver anything you want, as long as it's eligible for delivery. And the long who is assigned to you by the clearinghouse to take delivery has to take whatever you give him, because that's what the contract says. In the same way, after a certain point, after first delivery day, these are American-style options. You don't have to wait until a certain date to deliver. You can deliver whenever you want, as long as it is within the interval that's prescribed by the contract terms. So for a September contract, I can deliver on September 1st if I want to. That might not be financially sensible. Or I can deliver, if this is a 10-year note that I'm talking about, I can deliver on September the 30th if I want. It's my option. I own it. And how you value that, this is sort of at the heart of all the dark arts of basis trading. These delivery options aren't important right now, but depending on how old you are, how much experience you have, at least some of you can remember when these delivery options are worth quite a bit. So being able to quantify this is important. How do you get to them? Well, first of all, you have to get out the carry. The carry is mostly easy to estimate. What did I say it was? It's just the difference between the accrued coupon that you're earning on your Treasury position and the cost of financing to you in carrying that, in holding that position. Well, the accrued coupon is just fine. The only thing I'd ask people to remember, I'm not going to belabor this slide. The whole point is that one little line up there that says day count, actual over actual. If you're going to keep track of a basis position, or if you're going to compare basis positions, please make sure that you're computing the coupon accrual properly. And people make mistakes on that. The messier part of carry is repo financing. I would like to be able to tell you a lot more about the repo market. This is actually, people really can get hurt, or they can enjoy extraordinary profits, or just all sorts of inexplicable developments in spread trades because of what happens in repo. If I do a good job this afternoon, then maybe I will come back and I'll tell you more about repo. That's a big, long, and involved conversation, and a very interesting one. It's something that any student of the cash to futures basis needs to know, just for his own protection. But let's assume something really simple. So in this example, here we are. June 10-year note futures. Let's pretend it's 14th of May. What are you looking at then? You're looking at a bunch of Treasury note prices quoted on the afternoon of 14th of May for T+1 settlement. That's what's standard in Treasury, so it's for 15th of May settlement. What do you need to get? You need to get the accrued interest on those note issues from the last coupon to the settlement day. That's what you see in the third column from the right. Add those, and that gets you the all-in price, the spot price. Some people call it the dirty price. It's dirty versus clean. But anyway, as long as you've included the accrued interest, you're okay. Simply apply to that the term repo rate. That would be, technically you want that to be term repo from 15 May to 30 June. If you have lots of friends in the repo industry, you can get indications on 14 of May for the next day. But repo settles on same-day basis. So that's actually a rate that you would get the next morning, 15 of May. And let's assume for the sake of argument that it's 17.5 basis points. Somebody with a really good memory who wants to play stump the band will say general collateral was 22.5 basis points that day. He would be right. It so happens that most of these things that were deliverable grade into the 10-year note were trading 5 basis points special. So that's where I get that rate. Not that it would make a hell of a lot of difference for computing. But let's put these pieces together then. So let's just get carry out of the way. So we know what coupon we're going to earn on any one of these Treasury notes from 15 of May to 30 June when we think we're going to deliver. We know what our cost of borrowing money to finance ownership of any one of these Treasury notes is going to be from 15 of May to 30 June. Subtract one from the other, you've got carry. We computed the basis for each of these things earlier, and bingo, delivery options, the value of the delivery options is nothing more than the basis, the gross basis minus the carry. So here, this is a nice snapshot of what the delivery options that would be embedded in the Treasury contract for any one of these is worth. I've highlighted the 5 1/8 of May 2016. That happens to be the one for which the value of the options is lowest. It's a little more than a 32, about 1 1/10 32s. That turns out to be what is, on this day, the cheapest to deliver. That's not because that's got the smallest embedded option value. That's not a reliable gauge, but it often is the case that the issue that is cheapest to deliver values the embedded options least. So we've kind of circled around to what we think might be the cheapest to deliver issue. What makes the cheapest to deliver cheap to deliver? I mean, a lot of good Treasury futures traders and basis traders understand this instinctively, but if you put a gun to their heads and say, explain this, it's like, the details are hard. Instincts are very important. Always, always, always trust your instincts, but you need to be able to explain to yourself the logic of your instincts from time to time. I don't like the expression cheapest to deliver. What this really is, it's what's most opportune. There are two good measures that I've seen. One is the implied RP rate. You can see this all over the place on various Bloomberg screens. The other is the futures equivalent forward price. Let's take a look at each of these. I'll show you. The implied RP rate is kind of nice. It's intuitively pleasing to people. Why? What does it do? It transforms that cash to futures basis position into a money market interest rate. You bought this Treasury futures here today. You're going to deliver it into a Treasury futures contract at some future date. If you're willing to pin down that date, you know what the invoice price is going to be. You can turn this into a money market interest rate. That then allows you to compare this to other money market interest rates. Is this trade worth doing to me? Is it undervalued? Is it rich? The futures equivalent forward price at a theoretical level, it does the same thing, but it pushes everything out to literally a forward spot price. And what you do is take, you compute that forward spot price, deflate it by the appropriate conversion factor, and you get a futures equivalent forward price. And this allows you to do some really nice elegant things in terms of finding switch points. I'll show you in just a moment. It's important to know when the thing you think is cheapest to deliver is going to stop being cheapest to deliver. You know, if interest rates rise or fall by enough to make something else the most profitable to deliver, you want to know about that. And this is a nice, this makes it very easy to kind of identify that. So an implied RP rate is really, it's straightforward to compute. As we said earlier, the stuff that's highlighted in gold, that's the cash side. Okay, that's nothing more than the acquisition price of any one of these notes here. So our example involves notes for settlement on 15th of May. Fine, there's the spot price, there's the accrued coupon, there's the all-in price. That's done. The futures part of the conversation, that's out to the right. It's just as easy. You take the futures closing price, the daily settlement price for that day, multiply by the appropriate conversion factor. We're assuming, by the way, we're not assuming, it was the case that these things settled at 121 and 21.5 32s. So that's where you get those converted futures prices. Add the accrued interest that that would attach to any one of those on the 30th of June, and bingo, there's the futures invoice price. Put those into this formula up here, futures over cash, subtract 1, annualize. 360 day, actual over 360 day, it's a money market rate. And there you go, you got an implied RP rate. That's a bizarre bunch of RP rates. They're all negative. That doesn't look very attractive, does it? So one way to respond to those would be to say, why would I be interested in being long the basis at all? And one answer is, you're not. But another answer might be, maybe futures were misvalued. So here's a hypothetical. What if June 10-year note futures had settled a tick higher? Well, here's how this would have looked. Most of these implied RP rates, most of these implied money market interest rates are still negative, way negative, some of them. But you've got one, the cheapest to deliver, that's 14.25 basis points. That's a little bit south of, RP rates that were being quoted, but it's not ridiculously south. And the point is that you could look at that. If that makes sense as to what else is available out there, you could say, maybe the basis is undervalued by that much. So, if a bunch of other things in the market support that inference, that's worth buying. But the bottom line is, implied RP is nice. You just pick out the maximum, and that's what is cheapest to deliver for the short. If he's going to fulfill contract, that's the thing that's going to be most profitable for him to do so. You see why I'm excited about the next measure. I don't like having to compare these against other money market interest rates that may be off-market or weird or misvalued themselves. So let's try looking at futures equivalent forward prices. Remember what we're going to do. We're going to take the spot price that we see today, subtract from it the carry, that gives us the forward spot price. We deflate that by the appropriate conversion factor, and that gives us the futures equivalent forward price. And if you do just those steps, that's what you see in the column that's second in from the right. Well, guess what? This is nice. I mean, you can compute a yield to maturity for the spot price, you know, today. You can also compute a yield to maturity for any one of these for forward settlement on the 30th of June or whenever your delivery date is. That becomes really handy because you can then perturb these up and down and find out when things will fall in or fall out of cheap to deliver status. Now, Joe Guinan would be upset if I didn't show you the next picture, and so this is kind of what I'm getting to. And we're pretty close to the end. What happens if you perturb yields up and down? Can you all see the baby blue columns? There's a big thick blue line that sort of says where we are. Then there's a bunch of little baby blue things that show how cheap to deliver status moves. And you can see, okay, the 5 1/8 of May 2016 are going to be the cheapest to deliver issue, the issue that's most opportune for the short to use and fulfilling contract, you know, within a range of 70 basis points up, 30 basis points down. If rates were to rise a lot beyond 70 basis points, all of a sudden you've got a potentially rich array of things that become deliverable or that might slip in and out of, you know, cheapest to deliver status. And those include what, the 4 7/8 of AUG 16, the 4 3/4 of AUG 17. And that takes you up another 60 basis points. 4s of August 18 then become the thing that's best to deliver, cheapest to deliver. And I've done this in 10 basis point increments. You know, if I can do this, you can do this. This is just Excel. This is really easy. This is basically adding and subtracting. This is a nice way to visualize scenarios. What's important about this scenario? I didn't move the RP rate. All I did was move forward yields up and down. You can go through an exercise like this with very little Excel monkey business. This is really a simple thing to do. You can go well beyond this sort of elementary illustration. So you can get a VBasic program that shows interest rate slope, changing its pitch, up, down, or sideways. You can also feed in scenarios that show the repo rate changing with other market interest rates. You can also illustrate what happens if, like, one issue goes special, if the repo rate changes drastically for a particular issue. What impact does that have? It's a nice way to visualize this stuff. How am I doing on time? Are we tired? Are we hungry? I'll keep going. That's how to visualize the quality option. Now, a premise in all of this is that we knew when we were going to deliver. I mean, I've been telling you all along, gee, we're going to deliver on the 30th of June. Okay, that might or might not be so. It's obvious right now, these coupons on all these deliverable grade issues are very high, and repo is being measured in pennies. So, you know, if you go long a Treasury and finance it with repo, you're earning pretty good money. But that's not always so. And there are times when your cost of financing is perilously close. It may even be in excess of whatever accrued coupon you're earning. And it pays to remember then that, gee, you don't have to wait until the last day of the delivery month to deliver. You can deliver as soon as you want. So, you know, here's an example just to just to show. I mean, I've seen situations like this. I mean, I can go back, instead of pinning RP at 17.5 basis points, I can make it 4.5%. It will be there someday within our lifetimes. And what do you see? Third column in from the right. That's sort of the punchline here for me. Look at that. All of a sudden, carry, it's negative everywhere you look. Everywhere you look. And the logical thrust of that is, you know, if you're the guy who's long the basis, you know, long the Treasury and short the futures, you want to get rid of that Treasury as quickly as you can. You want to pop that to the next guy as quickly as you can. So in a situation like this, it's purely hypothetical, but, you know, it's a simple thing to do. You'd be valuing all this stuff as if September 1, or in this example, June 1, were your target date instead of June the 30th. Rules of thumb up top. It's very simple. Okay, I'll tell you what. There are a few. I mean, I see people making mistakes from time to time just on common sense stuff, or I get calls from people as to how to understand one thing or another. So there are little bits of just common sense and rules of thumb that are might be worth talking about. I'm going to set those aside just in the interest of taking questions. There are a lot of really good, or I shouldn't say there are a lot, there are a few, but we're fortunate. If you need to think about this, there are places you can go to find out. The better student you are of the Treasuries market, the repo market, the structure of the contract terms and conditions, the more adroitly and profitably you will trade these things. As I said at the outset, details matter, and this is one of the few trades where it really does set you apart to understand the details. And really, really good cash to futures basis traders invariably are people who are bird dogging those details, know exactly how they fit together. So here are a bunch of sources, a few books. And you know, I can keep going or I can stop, and I'm kind of inclined to stop, and let's take a question or two. Sir?
Your presentation, is it available in print right now? I mean, I didn't see it coming in, but is it in print?
You know, what I'd like you to do is just, you know, let's make sure our hosts know. It probably isn't in print, and I don't think you want to be walking out with a big sheaf of paper. You'd probably rather get it in a PDF, and I'd be delighted to send it to you. Okay. We'll do that for anybody in this room. Yeah, that's not a problem. Just make sure we know who you are and what your email address is. So that's easy. Yes?
You said that you would talk a little bit more about the repo market.
I'd prefer not. I could get started, and then, you know, somebody's going to hook me off because they should. This has become a highly concentrated market in which a few people know an awful lot. Their opinions matter, and everybody else has a back house seat. And that's just, you know, by way of saying that trading the basis has become riskier in some ways for people. I'd say in the last couple of years, noticeably so. There's been, if you visit the Federal Reserve Bank of New York website, you would be horrified and I think disappointed at just how messy the financing mechanism for the government securities market has become, and especially in the way of fails. I mean, people treat repo transactions as if they were sort of options. You know, I mean, I may be on one side of a repo trade and I simply refuse to unwind it or refuse to show up with my collateral to give it back to you, or, you know, and so there's been a lot of ill discipline, and there are a handful of dealers who benefit from this, and everybody else gets hurt. That doesn't mean you're not going to profit. It doesn't mean that you're, you know, not going to live to talk about it, but you just have to know what the risks are. You have to know who you're trading with or against. You have to be aware of what informational advantages some other person might have, and you know, insulate your trade from that. These are all broad statements. They're things you could say to me, but the details are interesting. They're, you know, with luck, there will be an opportunity. That's well worth discussing. You know, what exactly could go wrong, how and why. Other questions? Yes.
Since you mentioned fails, is there any kind of comment you have on the Fed's penalty for fails now, and then how that's causing negative carry, how that affects what's cheapest?
I'm going to take a risk and walk around because I think I can. I won't be in the picture, but that's probably a good thing. You know, it's funny. We thought that was going to matter a lot, and it doesn't seem to have. What it's done, I mean, so far, this is early days, okay, it hasn't been around all that long, but thus far, it appears to have done exactly what the Treasury Market Practices Group had hoped. It's brought discipline back to the repo market. I mean, the problem with the repo market was really simple in one way. It was just a complete, utter lack of discipline. You know, in the bond market, your word is supposed to be your bond, and holy smoke, it's incredible how many people have forgotten that. So, you know, the repo market has been under scrutiny. It's under incredible scrutiny. I mean, some of the biggest players in it are now essentially wards of the government, you know. So it's a little bit harder for people to get away with a lot of horseplay. I'm not sure yet what that penalty has done to make this so. I mean, this could be one of the cases where jawboning on the part of regulators was sufficient. But it looks as if, you know, the repo market has just become a more transparent and orderly thing. Let's knock on wood. I hope that remains so. It's still early days. It doesn't seem to have had any impact upon basis valuation, however. I mean, what it's done is simply to, you know, just bring trade certainty to the repo market itself. So, you know, it may have made trading the basis a little bit clearer than it had been, you know, 1 or 2 years ago. Does that answer your question?
Yeah, to a point, yeah.
Okay. No, but is there? I'm not.
Well, I was just wondering if there's something you had to adjust if, like, one of those issues became, you know, if there was a big fail or something and the penalty was there, if you had to make an adjustment to calculating carry on any one of those issues, and if that could affect the basis. Or could be misguided.
Remember that a fail applies to one party in a particular event. It's not a market-wide price. You know, if I fail to you, it's not like everybody is going to pay the penalty rate. You know, it's you and me. So the way to answer your question would be to say if there were a lot of people systematically or strategically failing on a particular issue, and we knew that a lot of people.
Because that kind of was happening for a while, wasn't it?
Yes, it was. This is prior to the adoption of this penalty. Do we know what he's talking about? Are you all familiar with this repo fail penalty? I mean, I'm having a good conversation with you, but I want to. Are you all familiar with this? Okay. The government securities repo market had turned into this circus sideshow, and the New York Federal Reserve Bank, about 2 years ago, convened what it calls its Treasury Market Practices Group. You can go to the Fed website, and you can find the TMPG's sub URL in all their documents. And what the then president of the Federal Reserve Bank of New York, Timothy Geithner, said is, look, idiots, you're giving us a bad reputation. This is the U.S. government bond market. You're turning us into a mess. There's no trade clarity. There's no trade certainty. You are going to sit down in this room and you are going to write a code of best practices. This is what you're going to do. So it was a bit like, you know, finding a bunch of guys out behind the gymnasium smoking, and, you know, sister brings them in and has them write a 500-word essay on why smoking is bad. It's actually worked out pretty well. I mean, these guys took their duties seriously. I mean, one of the things that they were charged to do was to come up with a code of best practices for repo. What do we do about fails? How do we cure fails? In Europe, there's a ICMA. It's like the old bond market association here. There's this European Bond Market Association, ICMA, that has a step-by-step procedure for how to cure a fail. That's how people do it. There's no controversy about it. There's no mystery. There's no uncertainty. Here, this is not so. And so, you know, the Fed asked this Treasury Market Practices group to devise this code of, you know, rules of engagement. And what your colleague was referring to then, one of these is that if I fail to you, well, you've still got my money, and you don't have to pay me interest on that, but at 22.5 basis points, I don't care, do I? Oh, now, what's different? I have to pay you the spread between, what, the overnight federal funds rate, target, and 3% per annum. So all of a sudden, I've got to pay you, so what are they using, 0 or 25 basis points? It's probably 0. I have to pay you 3% per annum for as long as I'm holding up the resolution of this repo. Okay, that starts to cost me money. And that, you know, the formula that they came up with is, you know, the penalty I pay you is going to be the spread between 3% and whatever the Fed's target for the overnight federal funds rate is. If that target gets up to 3%, well, then there is no, I mean, this thing sort of becomes less and less important as rates go higher. That's okay, you know. That's fine. I have less and less incentive to fail on somebody if I'm giving up a lot of interest. You know, if I'm giving up 3% per annum interest, that's probably something I don't want to do. So the question was, has this worked out? It wasn't instituted all that long ago. It looks as if it has imposed or restored order, or at least helped to do so. But there were a lot of reasons for why the repo market might be more orderly today than it had been. Feels like about 4 o'clock. I'll take one more question. Yes, sir.
So when the cheapest delivery changes,
yes,
how likely is that to induce discontinuity in the price of the futures? If it does.
Not very likely. There would be discontinuity in the futures price if there were to be like a really large move in interest rates. But if you're in the neighborhood of a switch point, I mean, if you have, like, you know, two issues that are jostling for cheap to deliver status, it's probably because the cash to futures basis for them is nearly identical. Now, what you will observe is that the value of the delivery option becomes fatter. I mean, so futures become cheap relative to cash. Why? Because that option that the short owns is worth a lot more. I mean, there's actually a horse race. There's actually, you know, the option isn't trivial. You know, it's very much at the money. So that's something you'd observe. But changes in the embedded option value tend not to be catastrophic. I mean, these don't hop around, you know, by large amounts. So you're not going to get a big gap in this unless there's been something that has caused all market rates to gap one direction or another, and then it's not the spread, it's just the market. All right, let's call that a wrap. I do thank you. This has been a lot of fun. I want to thank Joe and Tommy and Billy and you here. Thank you again.
All right, thank you all for joining us. Thank you, Fred. That was a great presentation. I hope everybody enjoyed it. Everybody who did give us an email address, we will send you Fred's presentation by, it'll be a PowerPoint presentation. So if you want it, make sure you have your email address. Thank you.